So hi again everyone, thanks for tuning in. In this video I'm going to go over some of my personal basic investment tips for beginners. Now I'm going to add the caveat again that I am not a financial planner. The correct investment decisions always depend very much on your personal financial situation, and the opinions expressed here are my own. Making investments always involves risks. Past performance not necessarily indicative of future results. All of that stuff. I'm just sharing some ideas with you guys about the way that I think about approaching investing and some of the things that I think would be more applicable to people that are just kind of getting started. You know, in the future, I might try to do a video like this that I produce a little better with some illustrations and references and so forth, but this was a question that came up a lot in the comments on my video review of Dave Ramsey's 7 Baby Steps to Financial Freedom. And I just wanted to get sort of a quick response back to the people that were asking those questions about what's the right way to start thinking about beginning to invest. So this is that. I'm just sitting down and I'm going to say what's on the top of my head, which I think will be of some value, particularly to people who haven't thought about these kinds of things a lot, because I have thought about them a lot. Not that what I think is necessarily right, but I've done the reading and been through the cycles, and so I can try to help you figure out what are the right things to think about. I'm going to try not to tell you exactly what to do, although by the end of this video I will create a hypothetical scenario and tell you what I would do in that scenario. But before I get to that, I just want to discuss sort of the conventional wisdom of investing and of saving and financial planning. I mean, this is super oversimplified. This is the conventional wisdom of financial planning. You want to start saving as early as you can, because the earlier you start saving, the more time you have to earn a return on that money. So that's called compounding. If you invest your money in a bond that pays 5% interest every year, if you invest $1,000 and you get $50 at the end of the year, you can reinvest that $50 into the bond, and so then the next year you get paid 5% on $1,050, so you get $5,250 in interest, and then you reinvest that. And it seems like it starts slow, but if you get started on that process early, eventually the interest that you're getting paid increases very fast, and you can be way better off than someone who saves more money in total but only starts putting it away later in life. So that's, that idea is accurate, I think. It definitely helps to start early. And then the way to think about your asset allocation is how much do you want in stocks and how much do you want in bonds. That's like the basic financial planning decision. It gets more complicated that in detail, but that's sort of like the most basic level. The idea is that stocks represent a potential higher return, but involve some more risk. And bonds should be safer, but you're not going to get as big a return. And so, I guess just to state the obvious, the return is how much you earn on your invested money. So, the conventional wisdom is that in the stock market, if you invest $1,000, you might be able to make 7, 8, 9, 10% in a year. So you're making $100 or 80 bucks in profits every year that you can reinvest in the stocks. However, there's more volatility in the price of stocks. So if you make 8 or 9% a year on average, it's going to be because some years you make 20 or 30%, and other years you make nothing or you even lose money. And so if it's important for you to be able to withdraw the money at any time, in particular for that reason, although this risk exists in general, if you invest in stocks, there's more risk. If you invest in bonds, there's less risk, but there's less return. In bonds, you're going to get 4 or 5% yield, but that should be every year. There should be less volatility there, and the risk should be lower. That's the conventional wisdom. The reality of today's economy is actually that I think the return you're going to get from either stocks or bonds is extremely unpredictable. And I believe that actually the overwhelming trend, or the overwhelmingly defining characteristic of today's investment climate, is that it's very, very hard to earn any kind of return on your money without taking a lot of risk. Bill Gross, who is a very famous bond fund manager, PIMCO is his bond fund, biggest bond fund in the world. Bill Gross is credited with coining a phrase called the new normal, where he's saying that, yeah, I know in the last 50, 60 years, except for the last decade where no one made any money, but the generation before that, 8, 9, 10% of the stock market seemed normal. It's not normal anymore. Not both bonds and stock market yields for the next generation are going to be lower. I don't know if it's true for a whole generation. That's very hard to predict the future, but the fact is that the effect of the Federal Reserve's manipulation of interest rates down to essentially zero is that you can't get a safe return. When I was talking about 5% in bonds, you actually can't get that. In 10-year Treasury yields, I haven't even looked in a while, they're like in the 2 or 3% range. At one point they were lower than 2%, they probably still are, which is insanely low in my opinion. Maybe they're 3%, that's still insanely low. And I actually think there's a lot of risk in investing in those bonds that the rate of inflation might go up. If you buy a 10-year bond, your money is locked up, for 10 years, but you get the 2 or 3% every year. And if inflation's at 1% and you're getting 3%, your real return is 2%. But if inflation goes to 5%, suddenly your real return is negative 2%. And because of all the debt that's been created by the central banks, I perceive a significant risk of inflation in the future. So I actually think that investing in bonds, particularly longer term bonds, is pretty darn risky. Unfortunately, I think investing in the stock market is risky too. I know that it's recently hit all-time highs, but the reality of the way the financial system works today is that it's driven by leverage. It's driven substantially by speculative positions from hedge funds that are putting on carry trades where they borrow money in low interest rate currencies and then use the proceeds to invest in higher yielding assets like stocks or more distressed debt securities. And that creates, I believe that's a lot of what's behind the recent run-up in the stock market, and it just creates a situation that's not very stable. If that momentum reverses, I think the stock market can easily have another period like it did in 08-09, where it basically got cut in half. It has absolutely nothing to do with fundamentals, because it has everything to do with the momentum of the leverage that exists in the over-the-counter markets that hedge funds and some of the banks play in. So, like I said, the conventional wisdom for financial planning is that you do a mix of stocks and bonds, and that the mix is a function of your age. So if you're in your 20s, for example, you'd maybe be 80% stocks and 20% bonds, because you have the time, you're young enough that you can take the risk. You're not going to need that money for retirement very soon. So it's okay if there's volatility in the stock market and the value of your investments goes up and down and up and down. In the long run, it should go up, so start getting into stocks early, and that's good. Whereas if you're in your 50s or 60s and you're approaching retirement, they'd say that invert it, be 20% stocks and 80% bonds. That way the majority of your money is tied up in safer, or is invested in safer things that will likely be there for you when you need to raise the funds to start drawing down on your investments for your retirement. You still have some stocks to get the juiced return, but basically one thing a financial planner could do for you is help you shift that portfolio allocation over time, so that when you're young you start in 80% stocks, and by the time you're old you move to 80% bonds. There's actually mutual funds that do this for you. There's a fund you can buy, it'll be something like the 2050 Target Retirement Fund, and that'll be a fund that is built for people who are trying to retire in 2050. So in 2013 it would have very much of a stock oriented allocation, and then over time it would be more towards bonds. If you have a 401k with your employer, you probably have some of those target retirement funds in there. And it's like conventional wisdom says that's a very prudent thing to do. If you are not in credit card debt and you're doing any kind of saving and you're making an investment in that kind of fund, you're doing way better than most people. But I don't personally own any funds like that. I think we can do better. And I think that today's investment climate is just so different from what it's been in the past. It would take me a long time probably to explain all the reasons why I think that's the case. But I think I explained the main one, which is the low interest rate environment created by the Federal Reserve means that if you want any kind of return at all, you've got to be willing to take some risk. And actually, because of what I think is a very high risk of inflation in the future, I would prioritize preserving the purchasing power of my assets even over and above making any kind of medium return. Basically, I have sort of a skewed investment approach. I either want to go for extreme safety and just how do I preserve my purchasing power no matter what happens, or I want to take a lot of risk to try to get a really big return. I think that those are where the better opportunities are. This is my personal approach. I always want to have some of my savings that I'm being very safe with, but anything that then goes to try to work for a return, it's very hard to get a really meaningful return. And I think that because of all the leverage in the system, some of the tail risks, some of the extreme scenarios that are only supposed to happen once in 100 years, they actually happen more often than that, and they're not necessarily priced correctly. So there can be opportunities to invest in things that will pay off in those extreme scenarios, and actually increase your purchasing power that way. But it's unfortunate that at least my opinion, is that really the only way to give yourself a chance to really get ahead is to take an obscene amount of risk. Like, you really have to be willing to kiss that money goodbye. You have to be willing to say, if with this portion of my investments, if I lose it, it's fine. I'll take 20% of my savings that I'm going to invest and say, I can handle losing that. Because I want to make an investment that might let it increase by 10 times. And if that happens, that would increase my utility. That would make me so happy that it's worth actually having a chance that it might be 80% that you're going to lose all this money. But if you have a 5-to-1 chance that you get a 10-to-1 return, you're actually getting huge edge in making the investment. So it can make sense to take some risks like that. So, okay, I'll try to make this a little more practical. At the end of the Dave Ramsey video, I mentioned an investment philosophy called the permanent portfolio. And that is a different approach to investment allocation decisions, that instead of making the decisions based on how long you have till retirement, it makes the decisions based on the actual movement and prices of the different asset classes. And the permanent portfolio actually defines 4 asset classes. There's stocks and bonds, like we've talked about, and then they also have cash and precious metals. And the idea is that no matter what the macroeconomic environment is, one of these asset classes will be outperforming. In an inflationary environment, stocks and precious metals tend to do very well. Bonds do not do well in inflation, and cash does not do well in inflation. But in a deflationary environment, bonds do well and cash is king in deflation, as stocks do not do well in deflation. And whether gold or precious metals do well in deflation, it depends. That gets into some more complicated monetary stuff that I hope to talk about eventually. But the permanent portfolio says, allocate, no matter how old you are, allocate your funds equally across these 4 asset classes. 25% stocks, 25% bonds, 25% cash, US dollars, and 25% precious metals, gold and silver. And then just rebalance as the market moves. So if stocks do really well, suddenly your stocks will be more than 25% of your portfolio. And if they ever get to be 35%, he recommends you sell stocks till it's back down to 25%, and you use the funds that you raised for making that sale to invest in the other asset classes, which will be cheaper at that point. So whichever one's the lowest, you invest until it gets close to 25%. And at any time, if say bonds do poorly and your bond allocation drops to be below 15%, then you sell your highest performing asset class and reinvest that money in your bonds to try to get that back up to 25%. So the permanent portfolio is a purchasing power preservation strategy, and I think it's extremely prudent. If if you want to reliably save your purchasing power, I highly recommend following a strategy such as that. And there's a fund out there called PRPFX, and you can just buy it. Many 401ks won't allow you to buy that sort of fund, but if you have any kind of a brokerage account, you know, E-Trade, Interactive Brokers is one I like, Scottrade, you know, Fidelity, Schwab, you should be able to buy that fund, PRPFX. Full disclosure, I do own some PRPFX. So I've gone over sort of two ideas of conventional wisdom. The first is the way to shift your allocation from stocks to bonds as you get older, which is a very sensible sort of way to be ready for retirement. And the other is the permanent portfolio way of rebalancing based on the actual changes in the prices of the asset classes, which is a very prudent way of trying to preserve your purchasing power. But now I'm going to get into just my personal speculations about what's going to happen in the near and medium and long-term future, and how I think about setting up my portfolio for that. And I'll try to answer the question, if I was on Dave Ramsey's step 4, meaning I had my $1,000 emergency fund, I paid off all of my debt except my mortgage debt, I had my 3 to 6 months of living expenses, and I was beginning to fund investment accounts. And it's always best to try to get in a tax-advantaged investment account first. So that's an IRA or a 401k are the main kinds. If you're in a 401k with your employer, your investment options are going to be limited, but it's almost always better to just take advantage of the tax benefits and just do the best of the limited options. I think there's ways to optimize it, but that's always uncertain, whereas the tax benefits are guaranteed. So get your money in a tax-advantaged account. If you don't have an employer with a 401k, you can set up an IRA account with any one of those brokers I mentioned earlier, and you contribute to it and you can invest in whatever you want in the IRA. Whether it's Roth or not doesn't really matter. There's math to figure that out, but either one you're doing very good. So get your money in an IRA, and so now I'm going to say, if I was on stage 4 and I had $10,000 to put in my IRA, what would I do with it? And if it was today. Today, I would leave half of it in cash. I'd put 25% in gold and 25% in silver. And the way I would own gold and silver is by buying the ETFs. GLD is the most liquid ETF for gold, and SLV is the most liquid ETF for silver. That's a very defensive posture on my part, because I think that we are very soon going to see a major increase in volatility. So if you were paying attention to the financial markets in 08 and 09, that's what volatility looks like. From the end of 08 to the beginning of 09, the stock market basically got cut in half. Gold went down by 30 or 40%. Silver went down by 70 or 80%. But cash did very well. The dollar, was very strong through that period. So that's what I would call a round of deleveraging. It's another video to explain what all that's about. I'm doing the series on the fundamentals of economics, and it's going to take quite a few lessons until we build up to the point where I can explain the fundamental concepts behind what deleveraging means. If you read like Market Watch or some of the financial commentary, they call it risk on and risk off. Like, is the market in a mode where people want to buy risk assets and get a return? Or is the market in a mode where people are selling the risky assets and fleeing to safety? Okay, so that flight to safety is what happened in 08, 09, and they sold everything except for the US dollar and for bonds. And the reaction to that occurrence by the central bank, by the Fed, was to create $30 trillion of new credit windows and expand their balance sheet from $700 billion to over $2 trillion to try to essentially prop up those markets, right? So to try to get people to flee back, to be willing to take some risk. So that has worked for a while. I don't believe that it's possible for it to work in the long run. And I think it's very likely that there's going to be another leg down. There's a guy Dent, Harvey, or Harry, or Richard. I always get confused with the Batman character. But there's a guy named Dent who studies the demographics. And basically right now, or he studies many cycles of which demographics are one. And there's a 10-year monetary policy cycle and there's a 50-year generational cycle. And right now in this like 2013 period, he's been saying this for 20 years. This guy was obscenely bullish in the 90s, but he's been saying the whole time, watch out for that 2012-2013 period, because that's where the cycles line up, and the deflationary effect of retiring baby boomers lines up with the deflationary spot in the monetary policy cycle. And I just think there's very likely to be another leg down that will be met with another round of monetary stimulus from the central bank. So this is the very tricky part of it. The dollar is strong and bonds are strong in that period where the market is fleeing from risk. But the response to that is for the central bank to create more dollars and to issue more bonds. And in the long run, that weakens the dollar and it'll weaken the price of bonds. So they've already created this monetary stimulus that is that's like the tinder for future inflation. And if we have another leg down, they're going to do even more of that. So on a 2, 5, 10-year time scale, I'm extremely bearish, is what financial people would say, on the dollar. I think there's going to be inflation, and I don't want to be owning 10 or 30-year bonds, and I don't want to be committed to holding dollars. But today, I actually think that more likely than not, sometime in the next year we get a sell-off in the stock market and we get a rally in bonds, and the dollar will be strong relative to other currencies. And at that point, gold and silver will also be selling at a discount because of the deleveraging, not because the fundamentals of owning gold and silver have changed at all. So I would hope to have some cash ready to buy more gold and silver on the way down at that bottom. And depending on how it manifests, I might even want to move a lot of money into stocks at that point. It's really hard to say in advance because the market is so driven by leverage these days rather than by fundamentals. You just don't know what's going to happen. But I think the long-term fundamentals for gold and silver are very strong because of the macroeconomic and the monetary policy environment, not just in the US, but globally. Globally, like every developed country has a central bank like this, and they're basically in a war to see who can weaken their currency the most, because the weaker your currency is, the more attractive your exports are. So there's a belief that that stimulates the economy. So if another country weakens their currency, you have to weaken it as much, or else your currency will strengthen and you won't be able to sell stuff to them. However, before all that inflation happens, I think we're going to get another round of deflation. So I think there's a lot of edge in waiting to move to move full on into precious metals or even commodities or stocks. So I don't mind sitting on cash today, but I don't really like it in the long run. Now the thing about gold and silver, silver is a lot more volatile than gold. Traditionally, they've both been used as money. Now gold is held as a financial asset and reserve by every central bank in the world. Silver is not, so gold definitely has a more entrenched monetary status, but silver has been used as money a lot. And actually, if you look at but the value of gold is a function of the confidence people have in the paper money system. Gold has a commodity value. It has a jewelry value. It is also one of the best conducting metals. It's extremely malleable. So you can take a gram of gold and make it really, really thin and long, and it's a very good conductor. So it has industrial, commercial, jewelry value. So there's some base to that value for gold. And then are people also wanting to hold gold as money? There'll be a monetary value on top. And the less confidence people have in dollars and euros and yen and paper money as money, the more they'll desire to hold gold as money, so the monetary premium or the monetary price of gold will increase. But it's interesting to look at how gold and silver behave. If there's you can look at the charts historically. When there is a cycle of inflation, gold will begin to increase in value, and it's only after the cycle of inflation gets mature that silver really starts to respond. But when it does, silver just completely explodes. And there's a couple reasons for that. But the essence of it is that silver has more commercial applications than gold. There's more industrial uses for silver. More of the price of silver has to do with those things. And so it's only after a lot of monetary value gets priced into gold that gold starts to get expensive and people start to look at silver as the cheaper monetary alternative. So there's an opportunity to hold silver and to really earn a big return, but there's risk there because silver's more volatile and it's more tied to the economy. So we were talking about that when deflation happens, the dollar does well. Gold may or may not do well, but in the first round of deflation, silver usually gets crushed because it's more linked to the economy, whereas gold is more linked to money. But eventually, the inflation that the central banks create as a response to the deflation will be good for both gold and silver. And if you look at like a 300-year chart of the ratio of silver to gold, the average ratio is around 10 to 15 to 1, which means that if gold was trading at $1,000, silver should be at about $100 or maybe $70 or $80 on average. But there's an incredible amount of volatility. Today, gold is trading at around $1,400 or $1,450 an ounce. So that would imply, based on that average, a price for silver of around $140 an ounce or $120 an ounce, something like that. But silver is actually closer to 20 an ounce. Maybe it's about 23 today, probably, something like that. So based on that long-term average, silver is underpriced relative to gold. So if you're trying to figure out a way, if you're willing to take some risk and you want to earn a really big return, I think investing in silver can be very smart. However, I'm not buying any silver today. Silver's at 23 today. It got close to, it was over 45 for like the blink of an eye 2 years ago. But 10 years ago it was at 5. I think silver is likely to go back to that $10 range before it explodes to 50 or 100. But I think 10 years from now, silver is going to be at 50 or 100 because of all that inflation that they basically have to create. The federal government has a fiscal gap of close to $100 trillion. It's almost mathematically impossible to grow our way out of that. So the only real way to eliminate that debt without blatantly defaulting is to monetize it. Which means printing the money, which means creating the inflation. But I don't think the central banks are going to have the political cover to do that monetization of the debt until it's another crisis moment like it was in 08-09. So I think it's very likely that we get another leg down before we get that next round of stimulus. So like I said, if I had a marginal 10 grand or if I had my first 10 grand to invest and I was at Dave Ramsey step 4, I'd do 50% cash, 25% gold, 25% silver, and I'd be waiting for the people on CNBC to start panicking every day like they did in 08-09. And once that level of panic got pretty high, I would get out of almost all of my cash and either move it equally into gold and silver or overweight gold or overweight silver depending on what my risk preference was. If I value a huge return and I don't mind taking risk, I move into silver. And if I value just preserving my capital, I move into gold. And depending on how cheap the stock market gets and what the political climate looks like, I might move a portion into stocks as well. So that was a little longer than I thought it would be. We'll see what happens in editing, but that's the first brain dump I can do on how to think about investing for beginners. I'm sorry if that was too in detail or whatever, or not in detail enough. I don't know. All I know is what makes sense in my head, but please, share with me your feedback. I love to hear the questions and comments, and if there's anything I can elaborate on or follow-ups or whatever, I'd love to hear them. So thanks for watching, and good luck.